Everyone is celebrating, everyone is buying, everyone thinks the market only goes one way. And that is exactly why the unthinkable is about to happen. Because markets don't destroy the fearful, they destroy the comfortable. Today, I want to talk to you about something most traders refuse to even consider. Not because they can't see it, but because they don't want to see it. Stocks have trained people to believe that every dip is a buying opportunity, that central banks will save them, that the rally will never end. But markets have a cruel way of humbling the crowd when confidence becomes certainty. And right now, I believe we are approaching one of those moments. A moment where emotions will overpower logic, where panic will replace greed, where fortunes will disappear because people were too busy chasing easy money to respect risk. The unthinkable is not impossible. In trading, the unthinkable happens all the time. And if you are not mentally prepared for it, the market will teach you a very expensive lesson. One of the most dangerous emotions in trading is comfort. The moment traders begin to feel safe, confident, and untouchable is often the exact moment risk is at its highest. Markets have a brutal way of punishing complacency because complacency blinds people to danger. It makes traders stop respecting risk. It makes them believe the market owes them profits simply because things have been going well for a long time. And history shows this pattern repeating again and again. When stocks continue rising month after month, people slowly forget that markets can fall. Fear disappears and is replaced by certainty. Traders stop preparing for difficult scenarios because they convince themselves that the trend will continue forever. Every small dip gets bought instantly, and this creates a false sense of security. Investors begin taking bigger positions, using more leverage, and ignoring warning signs because recent success tricks them into believing they are smarter than they really are. The market loves this kind of environment because it attracts emotional decision-making. When everyone becomes comfortable, discipline disappears. Traders stop using stop losses. Risk management becomes an afterthought. People begin chasing stocks at ridiculous prices because they are afraid of missing out. Instead of asking, what could go wrong? They only ask, how much more can I make? That mindset is dangerous because the market changes when people least expect it. Complacency also creates emotional weakness. Traders who have never experienced serious pain believe they can handle volatility, but when a real sell-off begins, panic quickly takes over. A person who felt fearless during a bull market suddenly cannot sleep at night when positions start collapsing. The same people who confidently bought at the top begin selling in fear near the bottom. This is how markets transfer money from emotional participants to disciplined traders. What makes complacency even more dangerous is that warning signs are usually visible before major declines happen. Valuations become extreme. Speculation increases. People begin treating the stock market like a guaranteed source of income instead of a place of risk. Yet most traders ignore these signals because optimism becomes addictive. Human beings naturally want to believe good times will continue. The crowd always feels smartest near the top because rising prices create the illusion of intelligence. Professional traders understand something important. Survival comes before profit. They know markets can do anything at any time. They never assume the current trend is permanent. Even during powerful rallies, they remain cautious because they respect uncertainty. They understand that protecting capital is more important than chasing every opportunity. The goal is not to predict every move perfectly. The goal is to stay emotionally stable while others lose control. The market punishes complacency because complacency creates carelessness. Careless traders stop thinking clearly. They stop adapting. They stop respecting the possibility of loss. And when reality finally changes, they are completely unprepared. In trading, confidence can help you execute, but overconfidence can destroy you. The best traders stay alert even when everything looks easy. They understand that danger often hides behind comfort, and the moment the crowd becomes convinced that nothing can go wrong is usually the moment when everything starts to change. The stock market is not driven only by numbers, charts, or economic data. It is driven by people, and people are emotional. That is why crowd psychology plays such a massive role in creating market crashes. When enough individuals begin thinking and reacting the same way, emotions spread through the market like wildfire. Fear and greed become contagious, and once the crowd loses emotional control, prices can move violently in a very short period of time. Most people believe crashes happen because of news alone, but the truth is that crashes are usually building long before the headlines appear. The emotional conditions are already there. During strong bull markets, optimism slowly turns into arrogance. Investors become convinced that prices can only go higher. Every rally strengthens the belief that buying stocks is easy money. This creates dangerous behavior because people stop thinking independently and begin following the crowd blindly. Human beings naturally feel safer when they are part of a group. In the market, this instinct becomes extremely dangerous. When everyone around you is making money, it feels uncomfortable to stay cautious. People fear missing out more than they fear losing money. So they chase trends, ignore risks, and continue buying simply because everyone else is doing the same thing. This emotional herd behavior pushes prices far beyond reasonable levels. At the peak of market optimism, confidence becomes irrational. Traders convince themselves that this time is different. They believe central banks, technology, or economic growth will prevent any serious decline. Risk management disappears because the crowd becomes addicted to easy profits. People start borrowing more money, taking larger positions, and treating speculation like investing. The higher the market rises, the more powerful the emotional illusion becomes. But markets are emotional machines, and emotions can reverse quickly. The same crowd that buys aggressively during euphoria can suddenly panic at the first sign of danger. It only takes one unexpected event, one sharp drop, or one wave of uncertainty to change sentiment completely. Once fear enters the market, people stop thinking rationally. Instead of asking logical questions, they react emotionally to price movement. This is where crashes accelerate. Investors see prices falling and assume something terrible must be happening, even if they do not fully understand the reason. Panic selling begins. Stop losses trigger automatically. News headlines become more negative every hour. Social media spreads fear faster than facts. Traders who once felt invincible suddenly rush to protect themselves at any cost. And because everyone tries to escape at the same time, prices collapse even faster. Crowd psychology creates crashes because most people react emotionally instead of strategically. Very few traders remain calm when markets become chaotic. Fear causes people to sell near the bottom, just as greed caused them to buy near the top. The crowd constantly swings between emotional extremes, and the market exploits those emotions relentlessly. Professional traders understand this cycle well. They know the crowd is usually most confident before major declines and most fearful near important bottoms. That is why experienced traders focus heavily on psychology. They understand that mastering emotions is often more important than mastering technical analysis. The ability to stay calm while others panic is what separates disciplined traders from emotional ones. In the end, market crashes are not just financial events. They are emotional events. They reveal how human beings behave under pressure, and unless traders learn to think independently and control their emotions, the crowd will continue leading them directly into disaster. For years, investors have been trained to believe that every market dip is a buying opportunity. Every time stocks fall, people rush in with confidence because recent history has rewarded that behavior again and again. Markets recover, prices climb higher, and traders who bought the dip are celebrated as smart and fearless. Over time, this creates a dangerous illusion, the belief that buying every decline is always the correct strategy. But markets are not that simple, and blindly following this mindset can become extremely costly. The problem begins when traders stop respecting risk. They become conditioned to believe that no matter how bad the situation looks, prices will eventually bounce back quickly. This confidence grows stronger after years of bullish markets and central bank support. Investors begin treating temporary recoveries as proof that the market is unbeatable. Instead of carefully analyzing conditions, they buy automatically because they assume history will repeat itself forever. But the market changes. Conditions change. And strategies that worked perfectly in one environment can fail badly in another. Not every dip is an opportunity. Some dips are warnings. Some are the early stages of much larger declines. The difficulty is that most people cannot tell the difference because emotion clouds judgment. When traders become emotionally attached to the idea of endless recoveries, they ignore signals that something deeper may be wrong. The illusion becomes even more dangerous during periods of extreme optimism. People stop asking whether stocks are overpriced. They stop considering economic weakness, rising interest rates, or declining consumer confidence. Instead, they focus only on recent price action. If the market bounced last time, they assume it will bounce again. This creates reckless behavior because confidence replaces discipline. Social media and financial news also fuel this mindset. Every small recovery is celebrated as proof that bullish traders are always right. Influencers encourage people to buy the fear without understanding the risks involved. New investors see others making quick profits and begin believing the market is easy. Many enter positions without proper risk management because they think the dip itself guarantees success. The reality is far more brutal. When a true bear market arrives, the strategy of blindly buying every decline can destroy accounts. Prices may continue falling much longer than people expect. Traders who bought the first dip are forced to watch losses grow. Then they buy again, hoping for recovery. When the market falls further, fear begins replacing confidence. What started as optimism slowly turns into desperation. This emotional trap becomes devastating because many traders never planned for the possibility that the market could stay weak for months or even years. They assumed quick rebounds were normal. But in serious downturns, rallies often fail. Recoveries become temporary. Hope keeps getting crushed. Investors who were once aggressive buyers suddenly panic and sell after massive losses. Professional traders understand that context matters more than slogans. They do not buy simply because prices are falling. They study market conditions, sentiment, momentum, and risk carefully. They know that successful trading is not about blindly repeating popular phrases like buy the dip. It is about understanding when opportunity exists and when danger is increasing. The dangerous illusion of buying every dip comes from forgetting that markets are designed to hurt the majority. What works repeatedly eventually attracts too much confidence, and excessive confidence always creates vulnerability. Smart traders remain flexible. They respect uncertainty. And most importantly, they understand that survival matters far more than blindly following a crowd that believes the market can never truly fall. Fear moves through the market much faster than greed ever does. Greed builds slowly. It takes time for confidence to grow, for optimism to spread, and for people to slowly convince themselves that prices will continue rising forever. But fear is different. Fear is immediate. Fear is violent. And once panic enters the minds of traders and investors, rational thinking disappears almost instantly. During a bull market, people feel relaxed and comfortable. Stocks rise steadily, portfolios grow, and confidence increases day after day. Investors begin taking bigger risks because success makes them feel protected. Losses seem temporary, and every small dip gets bought quickly. This creates the illusion that the market is stable and predictable. But beneath that confidence is emotional fragility. Most traders only feel brave because prices are going up. The moment the market starts falling aggressively, psychology changes completely. A trader who felt calm yesterday suddenly feels pressure today. Losses create stress, and stress changes decision-making. People stop thinking long-term and begin focusing only on protecting themselves from more pain. Fear takes control because human beings are naturally wired to react strongly to danger. In trading, financial loss feels like emotional danger, and that instinct creates panic. What makes fear so powerful is how quickly it spreads. When traders see red candles everywhere, they assume something terrible is happening even before they fully understand the reason. Watching prices collapse creates emotional urgency. News channels begin using dramatic headlines. Social media becomes filled with panic and predictions of disaster. Every negative opinion strengthens the fear already growing inside the crowd. This emotional chain reaction creates massive selling pressure. Investors rush to exit positions because they fear larger losses ahead. Stop losses trigger automatically, forcing more selling into an already weak market. Margin calls force leverage traders to liquidate positions. The decline feeds on itself. The more the market falls, the more frightened people become. And the more frightened they become, the faster they sell. Fear also destroys patience. During bullish periods, investors talk confidently about long-term investing and holding through volatility. But when markets collapse rapidly, many of those same people abandon their plans completely. They no longer care about future opportunities because fear makes survival feel more important than logic. Emotional pain becomes so overwhelming that they sell simply to escape the stress. One of the cruelest aspects of fear is that it often peaks near the bottom. By the time most people panic, much of the damage has already happened. The crowd sells after major declines because emotionally they cannot tolerate uncertainty anymore. This is why inexperienced traders often buy near tops during excitement and sell near bottoms during fear. Their emotions control their decisions instead of discipline. Professional traders understand that fear is part of every market cycle. They know panic creates opportunity for those who remain emotionally stable. While the crowd reacts emotionally, experienced traders focus on probabilities, risk management, and preparation. They understand that fear creates irrational pricing because emotional traders stop thinking clearly under pressure. The market will always test emotional strength. Greed can make people careless, but fear can make them completely irrational. And because fear spreads faster than greed, market declines are usually much more violent than market rallies. That is why emotional control is one of the greatest advantages a trader can have. In moments when the crowd loses its mind, discipline becomes more valuable than intelligence. Most traders only begin thinking seriously when panic has already arrived. They wait for the market to collapse before asking questions about risk, exposure, and survival. But by that point, emotions are already taking control. Decisions made during panic are usually emotional, rushed, and destructive. Smart traders understand something different. They know preparation must happen before fear enters the market, not after. The biggest advantage professional traders have is not intelligence, secret indicators, or perfect predictions. Their advantage is preparation. They spend time thinking about worst-case scenarios while everyone else is celebrating profits. They understand that markets can change direction violently and without warning. Because of this mindset, they never assume current conditions will last forever. Preparation starts with risk management. Smart traders know exactly how much they are willing to lose before entering a trade. They do not risk everything on one idea because they understand survival is the foundation of long-term success. Emotional traders often ignore this principle during bullish markets because confidence makes them careless. They increase position sizes, use excessive leverage, and convince themselves the market will continue rewarding them indefinitely. But when panic finally arrives, those same traders discover they were never truly prepared for volatility. Prepared traders also understand the importance of emotional control. They know fear can spread through markets faster than logic. That is why they create plans in advance. They decide where they will exit losing trades, how they will protect capital, and how much risk they can tolerate emotionally. Making these decisions before panic begins allows them to remain calm while others lose discipline. Another reason preparation matters is because market conditions can shift extremely fast. News, economic surprises, interest rate changes, geopolitical tensions, or unexpected events can trigger sudden selling pressure. In moments like these, there is no time to create a strategy from scratch. Traders who react emotionally under pressure often freeze, hesitate, or make impulsive decisions that increase losses. Those who prepared beforehand already know what actions they will take. Smart traders also prepare mentally for uncertainty. They do not enter the market believing they must always be right. Instead, they accept that losses are part of trading. This mindset keeps them flexible. If conditions change, they adapt quickly rather than stubbornly defending bad positions. Emotional traders often do the opposite. They become attached to opinions and refuse to accept when the market proves them wrong. That refusal can become financially devastating during periods of panic. Preparation also means understanding crowd psychology. Experienced traders know that markets become most dangerous when people feel invincible. Extreme optimism usually creates vulnerability because it encourages reckless behavior. Smart traders pay attention to these emotional extremes. While the crowd becomes overconfident, disciplined traders quietly reduce risk and protect themselves from possible reversals. When panic finally hits the market, prepared traders think differently from everyone else. Instead of reacting emotionally to headlines and collapsing prices, they focus on execution and discipline. They are not immune to fear, but preparation helps them stay functional under pressure. They understand that panic creates both danger and opportunity. While emotional traders rush to escape losses, prepared traders remain patient and strategic. In trading, success is not determined during calm markets. Anyone can feel confident when prices are rising. The real test comes during uncertainty and chaos. Smart traders know this, which is why they prepare before panic begins. Because when fear takes over the crowd, preparation becomes the difference between survival and destruction. In the world of trading, people become obsessed with prediction. Everyone wants to know where the market is going next. Traders search endlessly for the perfect indicator, the perfect chart pattern, or the perfect economic signal that will tell them exactly what will happen. They believe success comes from being right all the time. But the truth is far less glamorous. In trading, survival matters far more than prediction. The market is unpredictable by nature. No trader, analyst, economist, or institution can consistently forecast every move with complete accuracy. Markets are influenced by countless variables: economic data, interest rates, geopolitical events, investor sentiment, unexpected news, and human emotion. Even the most intelligent market participants are wrong regularly. Yet many traders build their entire identity around the need to predict correctly, and that mindset often leads directly to failure. The danger of prediction-focused thinking is that it creates emotional attachment. When traders become convinced they know what the market will do, they stop listening to what the market is actually showing them. Instead of adapting, they defend their opinions. They ignore warning signs, hold losing positions too long, and refuse to admit when they are wrong. Their desire to protect their ego becomes stronger than their desire to protect their capital. Survival thinking operates differently. A trader focused on survival understands that being wrong is normal. Losses are not viewed as personal failures, but as part of the business of trading. Because of this mindset, disciplined traders prioritize risk management above everything else. They care less about proving themselves right and more about staying financially and emotionally stable over the long term. Survival in trading begins with capital protection. Without capital, there is no second chance, no recovery, and no future opportunity. Smart traders understand this deeply. They manage position sizes carefully. They define acceptable risk before entering trades. They use stop losses when necessary and avoid exposing themselves to catastrophic damage from a single bad decision. Their goal is not maximum excitement. Their goal is endurance. One of the biggest misconceptions in trading is that successful traders win constantly. In reality, many highly successful traders experience frequent losses. What separates them from unsuccessful traders is not prediction accuracy alone, It is how they handle being wrong. They cut losses quickly, remain flexible, and continue operating without emotional collapse. Survival allows them to stay in the game long enough for probabilities to work in their favor. The market has a way of punishing certainty. Traders who believe they cannot be wrong often take excessive risks. They increase leverage, ignore proper risk controls, and become vulnerable to unexpected market moves. When reality challenges their predictions, losses can become devastating. Entire accounts disappear not because traders lacked intelligence, but because they lacked respect for uncertainty. Survival also requires emotional resilience. Markets can test patience, confidence, and discipline in brutal ways. There will be periods of drawdowns, confusion, and unexpected volatility. Traders who rely purely on prediction often struggle emotionally when reality does not match their expectations. Traders focused on survival remain adaptable. They understand that uncertainty is permanent and that flexibility is one of the most valuable skills in the market. At its core, trading is not about proving how smart you are. It is about staying operational through uncertainty. The trader who survives difficult conditions, protects capital, and manages emotions has a far greater chance of long-term success than the trader obsessed with predicting every market move. Because in the end, opportunities always return to the market. The only question is whether you are still standing when they do.